Cool. Good to go. Hello, good evening, everyone, and welcome to tonight's session. My name's Scott Agate. I'm founder of Green Shoots Property, and tonight we're going to do a full market briefing on Warragul in Victoria. So, a little bit more about me, just to give you some context. I've been in the industry for over 30 years. Personally, I've done over 4,000 property transactions. I'm known in Australia as one of the leading property negotiation experts, which is really my passion. So I coach a lot of the top tier buyers agents in the country on how to analyze and negotiate deals. I like to write a lot of daily on LinkedIn around the psychology of buyers and sellers as you navigate through the property buying process. So if that aligns with what you're interested in, if you're in that buying headspace now, then take a follow on LinkedIn or on Facebook. But let's get into the session tonight. So, an important framing point before we get started. Everything tonight is factual market information and it's general data. So it's not personal financial advice. I don't know your income, I don't know your equity position, your borrowing capacity, or your individual tax situation. So nothing I'm going to say tonight should be taken as a recommendation for you specifically. Okay. And every decision needs to go through your own accountant, your solicitor, your advisor, whoever your trusted team is that are surrounding you with. And later tonight, I'm going to show you exactly how we can help you model that out. All right, so stick with us as we move through here. Tonight's structure. So we've got 5 sections tonight, and they build on each other deliberately. The first one, it's about the budget. So there's been a material change to how property is taxed in this country, and the detail really matters more than the headlines itself. And we're going to start there because it changes what kind of property that makes sense today. The second one, the market and the data case directly for Warragul itself. Now, this is the biggest section, and I'm going to show you the full evidence base. I'm not just going to give you the flattering numbers. We'll get right into the weeds. Thirdly, why ready built? Ready built is what we've coined as new build houses that are physically standing now that meet the government's new criteria. And there's a clear winner. And signing a contract off plan here brings risks. So we don't do that. And I'm going to explain exactly why not. How we operate. All right. We work for you, the buyer. And it's the single most important thing to understand about tonight is who I'm paid by. We're buyer's agents, right? So we're engaged by the buyer and we're paid by the buyer and we take no kickbacks, no rebates, and no commissions from any vendor, any developer, or any builder. So if a property doesn't stack up from the data perspective, we've got no financial reason to tell you that it does. And three things sit behind that. Growth first, and this is super important. Every location is screened against the data platform that we use, which is called HTAG or higher than average growth. And it's their analytical platform that's institutional grade data. And we're looking at that at a single, sorry, I should say, we're looking at HTAG's data before we even look at a single property. So if a market doesn't clear HTAG's filters, we don't even go to the property level, regardless of how hard that region's being marketed elsewhere. So that's really important to point out for you. And strategy is first for us. So everything we do starts with a very specific and bespoke game plan. And it runs in 3 easy steps. Number one, your goals and your timeline. So your passive income target, your borrowing capacity, your time horizon for ownership, it's all mapped out before we look at a single property. Number two, your starting position. So this looks at your existing equity, your current portfolio, your tax position, and it's tracked in your very own game plans portfolio, which is the software tool that we use. And number three, your customized purchase. So every property we bring you gets stress tested against your own numbers that are in game plans and against your specific brief. So strategy first, property second. Make sure you're very clear on that. Now, Warragul, Victoria is in West Gippsland. So I'm going to build the complete case for this location. And I want to say up front, I'll show you all the numbers in their entirety. So let's focus on section one, the budget, before we get to those numbers. So we've got the 2026-27 budget. What actually changed though for property investors? And this is the part most people have heard about, but very few people have had explained clearly. Let's spend a few minutes here and then we'll get really into the market itself in Warragul. So the policy shift, negative gearing and capital gains tax are the two key things here. So there's two columns, and the difference on this slide is the single most consequential thing on any slide here tonight. And we'll take the left-hand side first, established property. So from July 1st, 2027 three clear changes. Number one, rental losses on an established property can no longer be used to reduce your salary income. They get quarantined. They only offset future rent from that same property. So the tax refund that made a lot of established investments work previously simply stops arriving now. Number two, it's sale time. The old 50% capital gains discount applies only to the growth accrued before the cutoff. Growth after that date is taxed under tougher rules, and there is no opt out for investors. Number three, and this really matters, established homes bought before 12th of May 2026, so this was the recent budget night, remain unaffected. This applies to new purchases. So if you already own established stock, you're grandfathered. Now, the right-hand column, let's talk about the new builds, already built, as we like to say. Full negative gearing stays exactly as it is today. There's no change before or after July 2027. At sale, you get to pick whichever tax treatment works out cheaper. You can have a choice that the established buyers simply won't have here. You get maximum depreciation deductions from day one, lowering your taxable income every single year you hold that property. And this can be significant. There's a big depreciation on new build properties. And you get statutory builder warranty on structural defects. So the practical effect of this policy, I should say, is that it's split the investment market in two. Same suburbs, same streets, same rent, but materially different after-tax outcome depending on whether the dwelling is new or established. That's the theory, and here's what it's actually worth in dollars. So the real cost gap, new versus established. So we've modeled this on two identical $800,000 properties with a 4% yield. Really important because I'm seeing a lot of manipulative marketing from experienced buyers agents, big buyers agents in the industry who have got huge marketing budgets and whose invested interest it is to push a certain narrative, which might be established property, because it's easier for them to be very transactional and do a lot of volume. And what they're doing, we've seen this in their ads, is modeling out two different scenarios and then showing that established wins. So we're not doing that. We're completing this maths on the same even keel. So $800,000 properties, 4% yield, same outgoings, same loan. The only difference is that one is new and one is established. So the only variables are going to be depreciation and negative gearing. That's really important to point out. So the new build costs $239 a week to hold after tax in year one. The established property costs $461, and that's a gap of $222 every week. And it comes purely from depreciation and negative gearing, not from rent or running costs. All right, so there's a huge gap here, and this is what we're really focusing on in terms of out-of-pocket expenses to hold this property long term. And that gap that gap does narrow over time as depreciation tapers off. But even allowing for that, across the full 20 years, say, of ownership, the new build costs $151,986 less to hold. 151 grand. That's not capital growth. That's not the sale. That's not capital gains tax. That's simply the cost of ownership. It's the money you didn't have to feed into the asset to keep it. That's a huge number, right? And here's why that matters more than it sounds. Holding cost is what determines whether you can keep hold of this asset. $151,000 of saved holding cost is what lets you stay in the market through a rate cycle instead of being forced to sell at the wrong moment. So it's a really critical part of owning property and ensuring affordability. Now, if we look at the rate environment, yield matters more than ever right now. So there's three key numbers. The cash rate is sitting at 4.35% as we're standing today, and it's on hold. That's the cost of money backdrop that we're all buying into. Now, the typical Warragul house yields at 3.4% gross. That's suburb wide. Tonight's shortlist, though, the four specific homes that I'm presenting average 4.34%. The gap between 3.4 and 4.34 is the entire point of the selection process, right? We're not presenting just any house in Warragul. We're presenting the specific homes that outperform the suburbs benchmark on those numbers. And also we're finding the sweet spot in the market where the demand is. People are looking for 4-bedroom houses. They're looking to spend around this price point. So this is a safe part to enter into the market, which gives you maximum interest from tenants and maximum resale interest from owner occupiers when it's time to get out of that asset. Section 2, is the market. So the market and the complete data case for Warragul. So this is the longest section of the night, and it's the one that I'd ask you to pay closest attention to. And I'm going to show you growth, scores, supply, demand, risk, infrastructure, population, and jobs. Need to take a breath. And where a number is soft, I'll say it exactly as it is, right? So let's have a look at the suburb snapshot and let's set the scene properly. Warragul is in West Gippsland's regional hub. It's 100 kilometres from Melbourne. It's to the east, and it's on the direct V line rail straight onto the M1, and it's at a fraction of outer metro entry prices. So Baw Baw Shire, the council area it sits in, is one of regional Victoria's fastest growing shires. It grew just under 19% between the 2016 and 2021 census. Critically, the local economy is diversified and it's construction led. So this is not a single employer town where one industry is, closing takes the whole housing market with it. And I'll show you the business data on that shortly. So full services are on the doorstep. West Gippsland Hospital, schooling from primary right through to TAFE, and an established retail core. And then, there's genuine lifestyle appeal beyond the commute. It's the gateway to the Gippsland High Country, the wineries, the produce, heritage towns like Walhalla. The four numbers on the right are the ones to hold on to, though. So a typical house price is just under $805,000 in this suburb. Typical rent here is about $527 a week. Local government area, as we said, is Baw Baw Shire. And this is a huge number, 846 houses traded last year, right? So there's a lot of liquidity in this market. And that last one matters more than people realize. And I'll come back onto it later on because 846 sales a year is what tells you there's a market to sell back into later. There's your exit strategy right there. It's that liquidity. So that shapes this place, but here's what it's actually delivered, okay, from those numbers. So let's focus on the growth and the data. So it's 4 periods. Cumulative growth for houses, what we're looking at here. 1 year's growth, 9.62%. It is huge. That is a pumping market. We define a hotspot market in Australia as being 10% and above, so very close to a hotspot market condition. Over 3 years, and this is what I find really interesting, it's only performed 8.32% growth. So I would say it's significantly underperformed in that light. Now, why I say that is because the average Australian house price over the last 20 years has grown at about 6% per annum. So 3 years growth at 8.32%, I would classify that as underperformance, but we perceive this as an opportunity. At the 5-year range, it's done 36.17%, so really strong growth, and phenomenal growth at 10 years, nearly 117% growth. So I want to draw your attention to something though, because if I don't, someone in the chat is going to, and rightly so. Look at that 3-year number as I've addressed. 8.32% over 3 years is lower than what it's done in the last 12 months alone. And that's not an error, right? That's telling you that this market went through a flat patch in the middle of this growth window. Call it about, 2.5% a year. And it's re-accelerated hard in the last year. And I'd rather you saw that than not. It's actually the more useful read. It tells you the recent strength is a genuine turn, not a straight line of hope. And the 10-year number is the one to anchor on. A home bought here 10 years ago has grown a whopping 116%, compounding at 8% a year on average. And that's not a forecast, that's its track record. And as I said, the average Australian house grew at 6%. So at 8%, it's significant overperformance. That's what it's done. And here's how the data, scores it looking forward. And we're talking about hashtags analytics here. So Hashtag rates these suburbs as we're looking nationally out of a score of 100. It's a combination of capital growth, cash flow, and lower risk, and it gives us an overall score out of 100. So capital growth is scored at 80, cash flow is at 90, and lower risk sits at 95. Overall, it gets a massive 88 out of 100. It's a phenomenal score when you're looking nationwide and at this price point and with the affordability that Warragul brings. And here's why that combination is really unusual, right? So in practice, these three rarely line up. Most markets are strong on growth, but they're weak on cash flow. And you buy a 2% yield and you just pray that it's going to grow. Or they're safe and cheap, but they go nowhere for a decade, right? And we see this, all the time. It's massive underperformance in terms of capital growth, even though it might have a high yield. You'll see that a lot now with buyers agents absolutely flogging Melbourne apartments, saying that it's a yield play, they're due to grow. But if you actually do any research on most of these apartment markets in Melbourne, they've done around 10% or 20% growth in the last 10 years compared to 116% in Warragul. The decade before that, they did similar numbers as well. So they're serial underperformers. You're buying it purely for yield and you're buying it off a buyer's agent who is purely transactional. They're volume driven and they know they can find a lot of those apartments to flog, and they're focused on that. We're going the long way around. We're looking to where we can outperform the market, get you the tax benefit as well, to allow you to continue to borrow and build serious wealth. So that 88 score means Warragul is clearing the bar on all three of those points that I mentioned at the same time: growth, cash flow, and low risk together. And that is the specific combination long-term investors are actually looking for, right? It's not common. So these are the reasons why we invest in these locations. And in the last 12 months, it's a reason why we outperformed the Australian house price growth by 153% here at Green Shoots Properties. So a really big, number for us in the last 12 months that we're really proud on. It's focusing on these types of metrics. Now, one more figure that isn't on the slide is the volatility index, and that reads 5 out of 10, and we're lower on their metric is steadier. So this is a low drama market. Yeah, it's not a boom bust mining town profile where you're timing an entry and an exit. It's a market you can hold through a cycle or more. So when we're looking at investing in these locations, we're not looking at investing for 3 years or 6 years. Some of our clients might be, and if that's the case, we're probably not going to buy in a market like Warragul. We'll go for a shooting star that's going to get you the maximum growth in the shortest possible time frame. That will come with risk. This doesn't. This is more of a long-term hold, and that's where the vast majority of our customers are looking to invest. So let's look at why those scores hold up and focus on supply. So market cycle here and supply constraints. So left side first. Market cycle position. Warragul is reading at peak, okay? Positive peak. Let me tell you exactly what that means and what it doesn't. It means growth is already underway. It's not a future hope you're speculating on. It's happening right now. And you can see it in the 1-year number. And we just looked at that, right? Rents are forecast to rise around 3.9% a year from here. So as a little bit of a, extra little piece of information in terms of how we project our capital growth in-house here. We work on a very conservative 6% per year because that's what the Australian house price growth has done. And we work on a very conservative 3% a year for rental growth. So 3.9% a year from here on is a very high forecast in terms of very strong rent growth. And it means this, right? You buy sensibly in this market and you hold for the long term. So if you're looking for a 6-month flip, as I said, this is the wrong briefing. I'd rather lose that sale with you than you expect to do a quick trade. It's not the right spot for that. Now, demand and risk. The transaction evidence. 4 numbers here, and these are transaction evidence, actual behavior. It's not consumer sentiment. Days on market here is 49, and that's a really steady pace. So that's how long it takes for a typical property to sell in this market. It's not a frenzy, but it's not a stall either, so it's a balanced market. Vendor discounting sits at 4.36%. So sellers are achieving around 95.5 cents in the dollar off their asking price. So there's negotiation room here, which is what I love, right? This gives us an opportunity to turn the screw and try and save our customers money. That's our job. But the market isn't, falling over. It's not soft. There's some movement there on price, but not a huge amount, which is a good balanced market. The vacancy rate here sits at 1.89%. Anything under 2% nationally is a really tight rental market. Landlords have the position here, not the tenants. So you're in a strong position here to command good rents. And that rent growth, we just referred to it earlier. In the last 12 months, it's 6.9% against that benchmark that we model of 3%. So over 5 years, it's up nearly 42%. And over 10 years, it's up a whopping 72.3%. Incredibly strong rental growth. And that's another big reason why we love Warragul. And that rent growth line is doing a lot of quiet work. It means your income from this asset has been compounding, not flatlining, which is what protects you, or your holding cost, I should say, as rates move. And the line at the bottom is the one that I'd underline, right? 846 sales, which we referenced earlier, and 423 rental transactions a year. That is a genuinely liquid local market, not a thin single buyer town where you're the only person trying to sell this thing in, say, 2040 when it's time to exit this property. Now, from an insurance perspective, hazard risk buffers where 100% is the top score or the lowest risk. Flooding here is 97 out of 100. Bushfire is 100 out of 100. So both comfortably low risk for the region. And none of these properties are affected from a insurance risk perspective that we're going to present tonight. So let's talk about what physically connects this market to Melbourne. Location and infrastructure. There's four categories here. Rail, let's start here. Warragul sits on the V Line Gippsland line with direct services into the Southern Cross Station, and the wider corridor has just had significant money spent on it. The Gippsland line upgrade delivered new and upgraded stations at Morwell, Bunyip, Longrary, I'll spit my words out, and Traralgon. Warragul's own service is its existing direct service, and what the upgrade has done is strengthen the whole Melbourne to Gippsland corridor that Warragul sits on. So next one is road. Direct access to Melbourne is via the Princess Highway, the M1, the main freight and commuter link between Melbourne and Gippsland. For health and education, the West Gippsland Healthcare Group anchors a growing health precinct, and there's a full complement of primary, secondary, and TAFE-linked education. For retail and employment, it's an established retail core, Warragul centre point in the CBD strip, acting as the commercial hub for the whole Baw Shire population. And it's busy, it's alive, it's active there. Like I've been down there recently again looking for property, meeting real estate agents. You know, that main CBD strip is really popular. There's a lot of people around. It's super active and it's really got a beating heart. And why does this matter to an investor, right? Because infrastructure is what makes population growth stick. People will move somewhere cheaper once. They only stay though if they can get to work, get to a hospital, and get their kids to school. So who's actually moving there based on all of that? So let's have a look at population and demographics. Baw Shire, 57,626 residents. So it's not a small 10,000 person town. It's a big area. So they've seen massive growth, 18.9% in terms of population growth. The median age there is just 40, and the average household size is about 2.5 people. Now, let me put that growth number in real terms. The Shire went from 48,479 people up to that 57,000 number between that 2016 and 2021 government census. And that's roughly 9,150 new residents in just 5 years. They're arriving into that local economy where these four properties that we're going to highlight tonight sit inside. And that is the demand base underneath every sales and rental figure I've shown you tonight. Population growth of that scale needs somewhere to live, right? It directly underwrites both your tenant demand now and your pool of future buyers when you go to sell. And look at the demographic profile because it tells you who your tenant is. The median age of 40, 2.5 people per household. That's not a student market and it's not a retirement market. It's family formation, which is precisely why we're focused on 4-bed, 2-bathroom, double garage homes or bigger, like 4-bed, 3-bath, one of them tonight. And it's what we've shortlisted. We're buying the stock that matches the population, which I said from the start. And one more number that isn't on the slide, median household income locally runs at about $1,900 a week. CPI adjusted this year, and that's a working family forming population with the income base to support both owner-occupier demand and rental affordability. And what are these people doing for work? Is the next question, right? So jobs and local economy. Nearly 16,500 registered businesses across the wider postcode catchment. Nearly 6,000 of those are actively employing people locally, and 57 of them are large employers with more than 200 staff on the books. And the largest single industry is construction. There's over 3,100 businesses. And I want to spend a moment on that because it's generally, useful. I should say it's a useful signal. I'll spit my words out. Construction leading the business mix tells you that this is a town still building to keep up with that population growth. It hasn't already peaked and rolled over. But construction is not the whole story, right? There's more important point here. Agriculture, for example, dairy farming across the southern half of the Shire, forestry in the Great Dividing Range foothills to the north, tourism on Melbourne day trip proximity, food and wine, heritage towns like Walhalla, and the Latrobe Valley Power Generation Precinct immediately to the east, plus the Thomson Dam is inside the Shire, which supplies about half of Melbourne's water. So read the statement at the bottom of the slide because it's the thesis for this whole section. This is a diversified regional economy. That is exactly the kind of jobs base that supports population growth and therefore housing demand through a full property cycle rather than through a single industry's boom. The failure mode for regional investing is buying a one industry town. This is not that. So, section 3, and this is where the section is that, sorry, I'll spit that out. This is the section where I'm going to tell you what we won't sell you. Off the plan, four risk categories we'll get to in a second. But first, section three, why ready built? What are the off the plan risks and what do they actually mean? So, yeah, if you've been to other webinars on a new build investing, you've almost certainly been shown a render and a completion date somewhere in 2028. I want to explain specifically why we don't do that. So off the plan, as I say, it's got four key risk categories for us. There's probably more, but these are the main ones that we believe are at the heart of the problem. So I've seen one of them, or every one of them, I should say, land on real buyers, right? So the first one here is a timeline risk. Construction delays are still routine. So a 24-month build becomes 30 months. Your pre-approval expires, and in 2.5 year window, personal financial positions could change materially, right? Jobs change, rates change, families change. You've committed today to settling on terms you can only guess at. So that's a real danger. The second one is valuation risk. This is one that we see a lot and it hurts the most. The bank agrees to lend against your purchase. It's 750,000 contract price, but 2 years later, the finished property value is up at 690,000. That 60 grand gap, it's got to come out of your own pocket, right? It's short notice at settlement before you default, and you don't get to renegotiate that price. So that's a huge risk. Thirdly, specification risk. The render and the finished product diverge, right? Finishes get downgraded, common areas don't arrive as shown, and by the time it's obvious, the contract's been signed for 2 years. And lastly, builder insolvency risk. And this is not, theoretical. Multiple established, well-known builders have collapsed mid-project in recent years. There's been thousands of builders go to the wall in the last 5 years post-COVID, and their buyers waited years for a resolution. Some are still waiting, right? So just this week, headline news yesterday and the day before, Battler in Sydney went bust. They owe $3 billion in debt with tons of unfinished projects, which will ruin families who had financially committed, but now they're unsure how they're ever going to get their money back. They've also missed all of the growth that came since they initially signed that purchase contract. So if you bought a property in 2024 and it's seen 2 strong years of growth until now, and that deal collapses, you've lost all that growth. So you're going to have to fight to get your money back, which you may not get all of your dollars back. And when you do, you've then got to pay 2026 prices, not 2024 prices. So I'm not telling off the plan never works, but I'm telling you that all four of these risks are borne by you, the buyer, and none of them are priced into the contract you're signing. So here's what we think is the alternative. It's what we've said already, is ready built. And what it actually means is here. So it means the house exists. It's finished. It's standing. And you can walk through it. You can touch it, feel it, smell it. And here's what that buys you, right? And I'll move through this at pace. So there's 2 pages here of positives. So growth first. This is key. Your capital growth clock starts on day one, not in 2028 or in that example when the build finishes. You get preferential capital gains treatment, the new build treatment we covered in section 1. You get depreciation, whopping depreciation from year one, a brand new asset. So the full depreciation schedule from the very first tax return. You get a wider tenant pool and higher rents. New stock rents to a broader pool, right? And it rents at the top of those estimated ranges from rental agents on the ground. So in the last couple of weeks, there's been a new white paper research done by a major depreciation company in Australia, which has got new build homes leasing for 3 to 5% premium over established stock in the same suburbs. So next one is lower insurance premiums. New construction is the current industry standards, which reduces your insurance premiums. Building and pest certainty, because you're doing it up front. You inspect the actual house, not a drawing. If there's a problem, you find out before you exchange, and we put them into the contract and we warrant with the developer that it's going to be finished before that property settles. There's less buyer competition and we get a lot of off-market access, right? So a lot of what we transact never hits the portals. So we've got less buyer competition. We've got motivated sellers because they want to get these properties sold so they can keep building, and that allows us to negotiate better. And these properties are priced against existing stock because they're finished. And this is a really big one to understand. You're paying an established market price for a new build asset. There's no display village premium baked in. And because this is a big thing that we hear a lot of people in the industry that are trying to poo-poo buying new build houses, is they'll say that you're paying a massive premium for new build, but we're actually pricing them exactly against established homes in the same suburb that are on the market at exactly the same time. So this continues. So we've got full negative gearing retained, as covered, unchanged by those 2027 rules. Full borrowing capacity preserved. So there's no 2 year contingent liability sitting on your file. blocking your next purchase. Lenders are reducing your borrowing capacity when buying established homes right now by 15 to 20% on average. So if you go into buying, thinking that you can afford to buy a property for 800 grand, but you go to buy an established property, the banks are going to reduce your capacity by 15 to 20% if they're going to lend to you at all, right? So if you want to build wealth faster and you need full exposure to your borrowing capacity, that's a really crucial thing. Next one is set and forget. So you've got a full warranty included, statutory building warranty on all structural defects. Rental compliance future proof. So it's built to the current standards, as I said. So you're not retrofitting to meet minimum rental requirements later. These are fixed prices. They're pre-negotiated by Green Shoots Property. You're not bidding at auction against emotional end user owner occupiers. The exit liquidity is into a really wide market. A finished house sells to investors and owner occupiers both. Warragul is predominantly owner occupied. That's your safety net when you go to exit. It's not oversaturated by owner occupiers, and it's below our metric of 40 years or less to pay that house off for the average person on the average wage that resides in Warragul. Next one is speed to purchase. You can be exchanged in a matter of days or weeks with us, and it's tenanted, 4 to 6 weeks later, not in 2 years' time. So we can do this right now, and if you want to, really quickly, because we've got stock that we've vetted in multiple different states across different price ranges and different yields, depending on what your risk profile and what your financial goals are. And here you get total transparency. There's no kickbacks, as we've already explained. It's where we started and we're paid by you. So take those, 2 slides together of those green ticks, and here's the summary, right? Ready Built gives you the entire tax advantage of new with none of the delivery risk of off the plan. That's the whole strategy in one sentence. So let's look at the actual houses next. The properties. Okay, we've got 4 homes, and I'm going to give you the numbers on each. And I'm going to show you the photos, and then importantly, I'm going to show you how each one is priced against established sales and real achieved rents in the same streets or surrounding areas. So tonight's shortlist, there's 4 houses. 57 Paramount Drive is on the market for $750,000. 21 Upland Drive can be bought for $780,000. 7 Tudor Terrace for $665,000, and number 1 Regent Avenue for $725,000. So it's a range from $665,000 up to $780,000. And we do have houses that you can buy for less and for more, but we believe this is the sweet spot of investing in Warragul with the best yields and the most desirable land sizes and the best quality fixtures and finishes and overall build size to balance what we believe is going to outperform in the market. So all of these houses, as I mentioned earlier, are 4-bedroom houses. Some are 4-2-2s, some are 4 and 3 bathrooms and 2-car garages. But before I go into them individually, a word on how this list was built. So these came out of a much longer screening process. So we've got properties that came off that list for price, for yield, for configuration, or because they got sold already before we got here. And what's left is what we'd actually put in front of our client base, right? So I'll flag this honestly. Availability moves really fast on stock like this. If something here has transacted between the shortlist being built and tonight, I'll tell you rather than let you find out later. One of the issues that we've faced this week alone is that our off-market options get put on the market too quickly by the local agents as demand requires it, right? So they're not even waiting for us, even though that we can guarantee them that we'll have a lot of buyer interest and eyeballs on these houses. They know they can sell them locally very quickly, and they're super motivated to continue to transact. So we've got to move reasonably quickly, but if this isn't the right timing, then no doubt there'll be more supply that comes into this market, and when the time's right for you, we can start that search. So let's look at the numbers that ties this back to the yield slide from earlier. So the shortlist, this is the whole shortlist in one table. The configuration, the land, the price, the rent appraisal, and the gross yield. So 57 Paramount, 4-bed, 2-bath, 2-car, 580 square meters of land, which is a big block for that location. You're paying a little bit extra because of the land size here. 750 grand. We'll rent for about $610 a week. We're very conservative on the rentals. So the agents are giving us higher rent returns up to 630, sometimes 650, but we're using the bottom end of that range for these numbers. And that gives us an estimated gross yield of 4.23%. 21 Upland is on 525 square meters. It's on the market for 780 square meters, 780,000, I should say. It'll rent for about $600 a week and it'll come in around 4%. 7 Tudor Terrace is on 317 square meters, and that's what brings that price down to a more affordable price point. 665 grand. It will still rent because it's a 4-bed, 3-bath, 2-car for $600 a week, and it'll return just under 4.7%. It's the highest yield on the list. And this is really important thing to know. we will look at the challenges here as to what brings properties into your price range, what makes it more desirable for resale. But often with tenants is they don't pay a premium for the extra rent. In some areas, in fact, the rental agents and the local sales agents will tell us that the bigger blocks are less attractive to tenants because they don't want to maintain a bigger area themselves. So they pay a premium for those smaller blocks of land, right? So often that is the sweet spot. And if you come into a market at a lower price point, it's always a bigger rental pool and always a bigger buyer pool on resellers. There's typically lots of people at those more affordable price points. And the last one at One Region Ave, it's on 515 square meters, 725 grand. It'll rent for about 620 a week and it'll give us about a 4.45% estimated yield. Now, we've physically inspected all of these properties. We've had rental estimates done on all of them independently, not from the sales agent. So this data has been vetted from the Green Shoots property team. Now, read the line above the table with me because this is the argument. Tonight's four home shortlist average is 4.34% gross yield. The typical Warragul house sits at 3.4%. That's nearly a full percentage point of outperformance against the suburb benchmark. These aren't just houses in Warragul, they're the specific houses we selected because they beat the suburb on the numbers. So let's take them on one at a time. Now, I'm not going to spend a huge amount of time on this because we can share this full recording with you. And any information that you need on any of these properties, we can send you straight away. So I won't spend too much time bogged down in each of these properties. I'll get through them quickly. But we've got 57 Paramount Drive here. The reason why we've chose this one is because it's a good balance of the size of the house and also where it's positioned within that market. So it's a nice balance, right? It's the biggest land component. It's where long-term capital growth really lives, is in the value of the land. That appreciates really quickly while the building itself depreciates, combined with a yield still comfortably above that suburb average. So the detail worth knowing when we shortlisted it, it's been on the market for about 8 days. The market's running on average 49 days. So it tells you, we've got to this early, but it's very likely going to sell in the coming weeks. Next one, Paramount Drive. Again, standing finish, you can walk through it this weekend. This is the whole ready build argument really in one photograph. So it's not a render, there's no completion date to wait for, and there's no specification to argue about with a builder. What you're looking at is what you're going to own straight away. And it's got great street presentation, big double garage. The land around the dwelling is really nicely set out. If you look at the neighbouring homes here, it's an established, completed streetscape, not a half-built estate. So really desirable from that perspective. Upland Drive. So 4-bed, 2-bath, 2-car. It's on 525 square meters of land. It's a really big house. It's 236 square meters of internal living, which makes it the largest home here on the shortlist. It's the lowest yield of the four, but there's two reasons why it's here, right? So first, it's the most house, as we've just said. So 236 square meters of internal living is really big. And on $1 per square meter of a home, it's really competitive. And second, and most importantly, when we went looking for a real rental comparable on this street, we found one asking a whopping $700 a week. It's $100 more above our own appraisal. So I'll show you that in a few slides. But if the market bears anything near that number, the yield story on this one will change materially, right? And I'd rather present the conservative appraisal, as I said, and let you see the upside than do it the other way around. There's some more images of Upland. And Tudor Terrace. So this is the best yield and the best value play on the list. So lowest entry price, 317 square meters of land, smallest footprint, $600 a week rental, but the really high 4.69% projected gross yield. So this is the trade-off, right, in its cleanest form. So you're giving up land to buy yield. So if it's really important for your holding costs, then that more compact block is the exchange that you're going to have to look at to bring that in line with the yield that you need. And that's going to be down to your serviceability. That might be a really good question to talk to about your broker. And it's certainly something that we can model through game plans, or we can have a chat about with you specifically to meet your out-of-pocket expenses each week and make sure that we can balance that financially. So it's got 3 bathrooms though in a 4-bedroom house, which is unusual at that price point. So that's a real letting advantage when you're trying to find a tenant. It widens your tenant pool to larger families and sharing arrangements if you've got a couple of tenants that are sharing it. So that compact block is used really well, but there's less maintenance, right? Less lawn to maintain is a feature, not a fault for a tenanted property. So we think that's going to be in high demand. Regent Ave. We think this is excellent value as well. It's got a big 515 square metre block. It's also a really big 223 square metre home and the strongest rental appraisal at $620 a week, which gives you 4.45% gross. So that combination, it's the best rent of the four, the second highest yield, and a solid 500 plus block. It's arguably the most balanced property on tonight's list after the property in Paramount. And the rent number here is well supported. So 65 Regent Avenue, same street, was leased in July this year at $625 a week. So our appraisal of 620 isn't a hopeful estimate. There's a genuine letting on the same street at that level. And of course, rents continue to rise as we highlighted in the data screen earlier. There's the last floor plan for that one. Now, pricing context. So how's it priced against established stock? This is a slide I'd ask you to take the most seriously because it answers the single most legitimate objection to buying new. Am I paying a premium, new build price? And we've tested that. We analysed 54 established Warragul house sales over roughly the last 18 months. And the full observed range across those 54 sales was 585,000 to 825,000. And the median sale price over the most recent 6 months, 24 sales there were looked at, was about 685 grand. So if you look back at tonight's list, every one of those sits inside that 585 to 825 band that established Warragul houses have actually transacted in. And of course, the market keeps increasing in price. And this is not display village markup. This is really important. We referenced that earlier. You're buying new build assets at established market prices. So rental prices achieved. Because a rental appraisal is worthless unless it's tested, every internal appraisal in this deck has been checked against a genuine real property nearby. And in most cases, it's on the same very street. So Paramount Drive, 610 a week we put on that. Number 8 was leased in November a year ago at $610 a week, and it's matched up exactly. So 21 Upland Drive, we put $600 a week. As I say, number 3 is on the market right now for $700 a week. That's another 17% above our estimate. 7 Tudor Terrace, we put $600 a week on it. It's currently one on the market for rent for $630 a week, which is at number 1, and that's 5% extra rent if you can achieve that price. And 1 Regent Avenue, we put $620 on. Number 65 Regent Ave was just leased in July at $625 per week. Again, very closely matched. So 3 of the 4 appraisals are matched or beaten by a genuine same street letting. And I want you to notice what we did there. Where the rental market set a higher number, we kept our conservative appraisal in the deck. Our yields on the comparison slide are built on the lower figure, not the higher one. It's how we always do things here because we don't want any nasty surprises from our customers when they own that property and they realize they can't get these grossly overinflated numbers that the buyer's agent or the sales agent has promised you that never comes to life. And all of that comes from recent rental listings in the immediate surrounding streets, right? Via that hashtag intelligence that we use as our data platform. So let's see where these all sit on the map in Warragul. So this is the property and the infrastructure map, and this is where the 4 properties sit against the infrastructure that we've already talked about earlier. The station, the freeway access, and the hospital precinct, the schools, the retail core, and so on. And I'd make one observation. All 4 of these are in established residential pockets with completed streetscapes. None of them are on the raw edge of a half-built estate where you're going to be living next to a construction traffic for, say, 3 years and competing with the next 100 identical houses at resale. So that's a deliberate selection criteria, not a coincidence. Where a property sits inside the town relative to the surfaces is what's going to determine whether it holds value when the estate is on the outskirts, finishing releasing stock, basically. Let's have a look from here of how this actually works, though. So if you want to secure one of these properties, from tonight's briefing to a signed contract, it's a short section. We're going to go through that, emailed questions that we've had through and answer some of these after this as well. So 6 steps, the process. I'll be specific about what happens at each one. Step 1, a one-on-one conversation, not a group recommendation. So we go through your equity, your borrowing capacity, and where this fits in your portfolio. If it doesn't fit, we simply say so. Step 2, it's finance pre-approval. So if you don't have a broker, we can connect you with one. We don't take any commission on that referral. So you bring your own or we'll help you match up with the right broker to fit your circumstances. Step 3 is contract review. So an independent solicitor reviews your contract. Independent means yours, not ours. We facilitate it. We don't control it. Again, if you need a recommendation, we're happy to do that and pass you on to someone that we know, like, and trust. Step 4, building and pest inspection. So we complete these before conditional exchange of contracts. This is the step off the plan buyers simply don't get. You inspect a real house before you're committed to the purchase. Step 5, we exchange the contract. So unconditional commitment happens only once every check is complete and not before then. And step 6 is settlement. And note this, your property manager is activated from exchange and the tenant search starts immediately, not after settlement. And that's typically weeks of rent you'd otherwise lose. And how we do that is we negotiate into every contract that we get access for a property manager to come through and do advertised photo shoot and open for inspections so they can go through and show tenants in that window. And the quote at the bottom is the promise. Every step is managed with you. You're not doing this alone. So it's a full service buyer's agent. And practically what happens tonight, if any of these four are of interest or you want to talk about other options, book a time using the link in the chat. That's step 1. It's a conversation. It's not a commitment. And then we can get into it from there together. So we've had a number of questions come in. So let's answer some of these questions. And thanks to those who sent their questions in. I'm going to run through these really quickly. If your question hasn't been answered by the time we wrap, put it in the chat anyway, and I'll come back to you by email personally. Question 1, I had this a few times. Why Warragul? Not Metro Melbourne. It's the most common one, why Warragul, and not a Metro Melbourne suburb. And there's really 3 answers, right? So first is price. An entry price around, 805 grand or well below, as we've established tonight, is well below the typical Metro new build pricing. And on the same deposit, that widens your serviceability headroom. So you're not stretched to the limit on day one, which is what determines whether you can hold through a rate cycle. Second, the data doesn't support the assumption, right? Warragul scored 88 out of 100 on H-Tag's overall residential comparison score, and that puts it in the same band as many well-regarded metro growth corridors. The idea that regional automatically means weaker fundamentals is a prejudice. It's not a finding. Now, in addition to that, the last webinar that we ran about 6 weeks ago, we did in Sunbury, which is in Metro Melbourne. We've since purchased probably 10 properties for customers in Sunbury. And if that's more aligned with what you're interested in, let's talk about Sunbury and other locations as well. So connectivity is the third one. Warragul sits directly on the Gippsland rail line and the Princess Freeway corridor, right? So it's only 100 kilometres from Melbourne and it's got a direct service there. So it's not disconnected from Melbourne's labour market, which is exactly the thing that kills regional investments that don't work. Next question, what if the property sits vacant? It's a fair question. It's one that keeps people out of the market. So vacancy in Warragul, we've explained, is just 1.89% in July. That's a very tight rental market, not a soft one. Under 2% means tenants are competing for stock, not the other way around. And the depth is real, right? 423 rental transactions last year. It's not 3 data points and a hopeful trend line. It's a functioning rental market with genuine turnover. And third, and this is a process rather than data, right? Your property manager is activated from exchange and the tenant search begins immediately, not after settlement. When you're already paying the mortgage, that becomes a problem because you're sitting there with a vacant property and it's typically weeks of rent that you're going to be missing if it drags on. I'm going to be straight with you though. No one can guarantee zero vacancy, right? So what we can do is buy into a tight market, buy the configuration the local population actually wants, which is in this case, it's a 4-bed family home in a market with a median age of 40 and 2.5 people per household, and start leasing that process early. That's the risk management, but it's not a guarantee. Question 3 is how liquid is the exit? Can I actually sell this thing? So 846 house sales last year. That's a genuinely transacting market. It's not a thin single buyer town where you list and wait 18 months for the one person who wants it. A median of just 49 days of market confirmed buyers are active. It's steady, but not scarce. And the third point is the one people miss, right? Warragul is predominantly owner occupied. That matters enormously at resale because it means your buyer pool isn't just other investors doing yield maths. It's families who want to live there and families buying emotion and lifestyle, which broadens your market rather than narrowing it. And that's the structural difference between a regional service centre and a pure investor estate. In an investor-dominated estate, every seller is competing for the same small pool of yield buyers. Here, you're selling into the whole town. Question 4, is it a short or a long-term hold? Long-term. I'd rather say that clearly than have you buy this on the wrong expectation. The average local hold period is 7.3 years. And importantly, in Australia, the average household, the average house, I should say, is held for 7 years. So this is slightly above the national average. And it's a market where owners hold, they don't flip. And that's the part of why supply stays tight here in Warragul. It's currently reading at cyclical growth peak, right? It's backed by tight supply and continuing rent growth. And let me be honest about what that means in both directions. Growth is already happening rather than being a forecast. And equally, the forward models on any market at peak carry a range, including years that could come in flat or negative. And the case here is for a multi-year hold through the cycle, supported by yield. It's not a quick trade. And if that's what you're after, as I said earlier, this isn't your briefing. But otherwise, this is a fantastic long-term hold. Which brings me to the last point on the slide and where we're going to finish. That's exactly what your game plans brief is built to model. Your own hold period, your own numbers tested before you commit to anything. So let's have a look at game plans, this amazing software that we use. It's our planning platform. It's the platform I promised you at the start. It's built around your numbers, not ours. And it's three parts, right? So it's portfolio tab. Every asset you own, the current value, your equity, the LVR, how much you can actually deploy into the next purchase. That is, of course, if you own anything. Most investors don't know that number precisely, and it's the first thing we established. Next up is the plan tab. So you set your passive income target, the real number you want to be earning without working. And we model acquisitions against your own position to get you there. And the brief page, right? Stress test any purchase before you commit. Change the yield, change the loan structure, change the interest rate, and see the result live. It's the same platform behind the negative gearing and capital gains tax numbers I showed you in section 1. And the question I always get at this point is, what does it cost me? And it's nothing extra. Game Plans is software we license, we pay for it, and it's included in our fee. It's a one-off lifetime subscription. So there's no monthly charge, no annual renewal, nothing to cancel, I should say. And it's yours to keep, right? For this purchase and for every purchase you make after that. And it's such a powerful tool, which I use for my own property portfolio, and I simply cannot recommend it enough to anyone that's going to be adding to an existing portfolio or just starting out on the journey of investing. So that's the Warragul regional briefing. So quick recap of the 4 things that are worth remembering. Number 1, the tax treatment of new builds versus established has genuinely diverged. And after the 1st of July next year, that difference gets material. New builds keep negative or full negative gearing and get the choice at sale, right, with the capital gains treatment. Established purchases from the 12th of May onward this year don't get that. Number 2, Warragul's fundamentals stack up on the data, not on the story, right? 88 out of 100 overall on H-tag, tight vacancy, very tight, supply, strong demand, very liquid market. It's diversified economy, construction led. It's in a shire that's growing its population strongly as well, just in the last 5 years. Thirdly, the 4 homes that we've shown average 4.34% gross yield against that suburb typical that's far below it. So every one of these are priced inside the range that established Warragul houses have actually sold in the last 6 to 12 months. Fourthly, these are ready built. They give you all the new build tax positions with none of the off the plan delivery risk. So if you'd like to go further, book a time, right? Use the link in the chat. That's a one-on-one conversation about your position with me. I'm the founder of the business. I do all the work on strategy. I talk to all of my customers and hold your hand all the way through the process. We're a small business, as I say, been doing it for over 3 decades and heavily involved from start to finish. There's no obligation, no commission from any vendor sitting behind my advice. So I'm going to give you unbiased, independent views. And the final reminder, everything tonight has been factual market information and general data. It's not personal financial advice. So please make your decision with your own accountant, solicitor, and financial advisor who can assess your specific position. Lastly, thank you all very much. If you've stuck through to this time, I appreciate you taking time out tonight. Enjoy the rest of your evening. Thank you very much.